So good afternoon, my name is Mark Stapp. I'm the Executive Director of the Masters of Real Estate Development Program at Arizona State University. And I'm here to talk to you about financial analysis as the second part of our NAIOP Emerging Leaders Program. So I'm going to talk to you today about the process of financial analysis, as well as the basic elements of that analysis and the tools that we use to determine the quality of a particular target investment. So that's kind of the overall learning objectives. When I teach financial analysis, I use this saying to remind people that we have a tendency to create these things, and we act as though they are absolute. And we'll talk a little bit about one of the first things you have to do is make a decision about why you're analyzing something and what you're trying to get out of that analysis. But this particular saying is that reminder that, you know, we create these things and we use them for various purposes, but we have to take them with a grain of salt. And I'll talk a little bit more about why I say that. So this business, the business of real estate, is a business of making decisions today about things that won't happen for a long time in an environment we have little or no control over, right? And we're uncertain about. So from a business decision-making standpoint, that's like a horrible situation, right? It's like the worst possible situation because you're trying to make a really good decision about investing money, about investing time, and you're making decisions about alternatives that you may have. So the question is, what's the right thing to do? So we look at this in terms of evaluating suitability. And that suitability, because it's uncertain future, uncertain information, uncertain characteristics, we have to look at this from the standpoint of probability. And it's the probability that what we're looking at, it's the probability that the conclusion we come to is correct. And we'll talk more about how probability begins relating itself to risk assessment, and calculating the merit of a particular investment. It's where we get cap rates from. That's where we make all of these other decisions based on, is probabilities. So the question becomes, how do you make a good decision? With all of this uncertainty and the need to make a very specific decision today, how do you do that? How do you make a good decision with all of this uncertainty? Less than perfect information, uncertainty about the future, okay? Not all of the information you may absolutely need to make a really good decision. So you have to be informed, right? That's what our due diligence process is about, is collecting information so that we can be informed about whatever we're looking at. But due diligence is time consuming, it's expensive, and a lot of times you don't always have the time, the luxury to collect all the information, or it may not be available to you. So I have a saying that facts are expensive. Facts are really expensive. Right? As we begin looking at property and wanting to know more and more and more to make good, sound decisions, we begin realizing that it gets really expensive to be absolutely right. And if you're in escrow with something, right, or you're looking at a property, trying to decide where you should even pay attention to it, you're not going to have all the facts necessarily. Or you're not going to know whether they're good facts or bad facts. So what I tell people is it's not what you know that will kill you. It's what you don't know that will kill you. So why do I say that? You're shaking your head.
I mean, if you know about it, you're going to put it in your pro forma, so it's not going to kill your budget. But if you don't know about it, it's not going to mean your pro forma is going to pull up your deal.
If you know it, you can plan for it, right? You can establish contingencies. You can mitigate it, right? But not knowing it means it can surprise you. One of the problems is sometimes you think you know something, right? You have all the best intentions and you did the best job you can, and you still didn't get it right. I was reading a report regarding the construction industry. And you would think that today, all right, this time period with BIM modeling and all of the other tools that are used for designing and estimating the cost of construction, that you should be able to pin this stuff down. I mean, that's just pragmatic implementation of something that's already been decided. It's only about 60% of projects come in on time, on budget. It's like, really? That's a crazy low percentage of projects that come in on time and on budget, right? So, and that's a known thing where people have looked at it, it's designed, the details are there, and it's been bid, and they still get it wrong, right? Because all sorts of stuff happens that we can't predict. So how do we deal with these uncertainties? Well, we don't know, right? So we've got to develop some methodology for trying to understand what could happen, right? Versus what we want to have happen. And so we go through this process called modeling. Financial analysis is nothing more than modeling. It's financial modeling. So modeling has to do with trying to describe something. It's an imitation of the real thing. It's not the real thing. So the pro forma is not the real project. It's not the real property. It's an imitation of it. It's something that we created to try and understand it. We use it to establish a plan. So if we're buying something and we've gone through financial modeling, that sets our target for it. It's not exactly what's going to happen, but it sets our target. So a plan is not an end in itself. A plan is a means to an end. And so the financial model is intended to provide some framework for you to move forward with in hopes that you achieve what you set out to achieve. So two perspectives here, the what is and the what could be. And it really depends on why you're modeling something, right? It depends on what your objective is. If I'm looking at a piece of dirt and I've got an idea for a development on it, that's what could be. If I'm looking at a building that's fully occupied, triple net, single tenant, triple net building, right? That's what is, kind of, okay? Because there's other elements that creep into this analysis, and it has to do with the future. It has to do with other factors that will affect what we think it is today. Will it be that way at some point in the future? So we have to keep these perspectives in mind. So modeling requires that we convert our ideas into numbers. We talked about that last time, right? Numbers tell a story. So you got to convert it into numbers. This is a business where, unfortunately, we can't build something and see how it works first. We can't say, I'd like that, okay? Can I try it for a while and see how it functions? That's a great office building, and I've looked at it. Can I just have it for a while and make sure that it's actually going to perform the way I think it's going to perform? It doesn't happen in this business. Right? If we're building something or developing it, right, now we're making wild guesses about what we think can happen. So we have to convert all of these things into a set of numbers so that we can see how this thing is likely to function. If we were building a car, right, if we set out to manufacture cars, or we set out to manufacture your cell phone or some other consumer product, we would build a prototype. First, we would develop an idea. We would establish some sketch concepts for it, right? Then we may develop a model. Today, we use 3D modeling, right? You can produce a prototype really quickly. So we would prototype it, right? We would prototype it at a gross level first, just maybe shape, right? And then we would take it to the next level, which may be function, right? And we would test it with people. You can't do that in this business. You only have one way to do that, and it's through financial modeling. Yes, we can have the architect produce a 3D model, right? And we can produce a digital 3D model, we can produce a physical 3D model, we can hold it up and we can look at it, right? But that doesn't tell us how it's actually going to function. That just kind of gives us a sense of aesthetic in functionality as far as space. We want to know how it's going to work as an investment vehicle from a financial perspective, right? So the first thing we have to do in this process is we have to express actual and assumed financial performance. What do we hope this is going to do? What is our basic intention here? And that's our return requirements, it's our capital requirements, how much equity do I want to put in, how much debt do I think I can raise, what kinds of returns do we expect to have? You have to identify those going into this. If you don't have those measures down, right, then you really don't know whether something's going to work for you or not. The second thing you have to do is you have to summarize anticipated events. And those anticipated events have to do with time, has to do with activities, right? Because this is how we begin converting things into numbers, is to understand these intended activities. So why create a financial model? Why do you think you create a financial model, given what we're talking about? What are you trying to do? You're hoping you're going to make money. What's that?
See whether the project is feasible.
See if it's feasible, right? You need to decrease the probability of failure, right? You can buy anything you want. You can make a decision to go develop something. You can tell a fabulous story. How many of you have seen projects get funded and you say to yourself, that's unbelievable. I have no idea why somebody would invest in that. It's monumentally stupid, okay? But people will do those kinds of things based on a story. The story alone, if you're a good pitch man and you can convince people, you get them to give you money, has nothing to do whether it makes any sense or not, right? So what we're trying to do is decrease the probability of failure by understanding how these things will work in detail, right? And we're trying to increase the probability of making a good business decision, right? How do you make the decision with confidence to pursue something? How do you look an investor in the eye and go, yeah, I'm very confident this is going to work the way I said it's going to work? How do you sit down with the banker and negotiate a transaction with terms that you feel comfortable you can actually live with, right? If you don't do this and you don't understand it significantly, all you're doing is guessing. So we're trying to increase the probability of making a good decision. So financial modeling is nothing more than a decision-making tool. It's something that's going to help you make an informed decision with confidence. So the way I explain this to people, and I'll get to this in a minute, is it's a bet. So you're going to go through your due diligence. You're going to evaluate the opportunity, right? You're going to collect information. You're going to develop some investment structure. You're going to analyze it, right? And you're going to go through a bunch of conceptualization. There's a point where you have to make a decision, right? And everybody goes to the lower right-hand corner of that pro forma and they go, okay, this looks like it'll work. At that point, you make the decision to proceed with the project and you're going to plop your money down or somebody else's money, or you're going to agree to make a loan because you're an analyst for a lender, you know, and that's a bet at that point. That is not reality. That's a bet that that's actually going to happen. So the question is, how good a bettor are you, and what do you need in order to increase the chance you made a good bet? So the first thing we end up doing is facts are expensive. We don't have all of them. We don't know what the future is. Even if we have facts today, right, we're making decisions about something that hasn't happened yet and might not happen for a long time. So we have to make assumptions. And every one of you knows what assume means, right? So we've got to make assumptions. That pro forma is full of assumptions. That's why I start with that saying, They're like perfume. They're to be sniffed, not swallowed, okay? It all has to do with how good the assumptions actually are. So the quality of your assumption is the key factor here. And the question is this a story that we're going to tell that's fictional or non-fictional? And the more we have to guess for our assumptions, the more fictional the story becomes, right? And what we really need is to get as close to nonfiction as we possibly can. But that depends on the facts, and it depends on the assumptions you make about those facts in the future. So is your story fictional or non-fictional? So basic steps here for this process. Establish investment objectives and metrics, right? What are your return requirements? What are your capital requirements? All of those things become important. But there's also the non-quantitative objectives, reasons that you're doing this, right? Things you're trying to accomplish. You need to clearly understand why you're trying to do something, why you're buying it, what you're trying to achieve by buying it, by developing it, by redeveloping it. There's a story behind that as well. Then you got to go collect facts, right? Your due diligence. Your input assumptions come from your due diligence. Physical, legal, political, economic, and financial, right? Your ability to collect as much reliable third-party information as you possibly can, right? And be able to convert that information into a set of assumptions about this target acquisition. So you can plug them into your pro forma. Because then you have to start making assumptions about this thing. Simply because a building is 90% occupied, right, doesn't mean that it's going to be 90% occupied 2 years from now. Doesn't mean it's going to be 90% occupied 2 years from now with the same quality credit tenants, or that they're going to be paying the same rents, or that the operating expenses on the building are going to be the same, right? So the world can change in subtle ways or significant ways. Everybody who made a decision to invest in single tenant, triple net Circuit City deals, okay, because they were considered to be national credit tenant, these things are golden. Let's get as many of them as we can, okay, had a rude awakening. And so part of the collecting of facts is understanding underlying credit and the ability to look at the covenant on a lease and understand the quality of that covenant and the quality of that tenant. So even if it's an occupied building, doesn't mean it's going to look the same way in 2 years from now or 3 years from now or whatever your horizon is. The other thing that happens is real estate is fixed, it's durable. We're sitting in one of those places that at one time, this was the best, one of the best office complexes in metropolitan Phoenix. Physical obsolescence, social obsolescence, competitive alternatives creep into the marketplace, right? And it changes its relative characteristics. Not its real characteristics, but its relative ones. So how do you make assumptions about that? So if numbers tell a story, right, your pro forma, right, is how that story is organized. So what I try to get people to do is understand the fact that you've got to set your pro forma up to help you tell the story you're trying to tell, right? And so in Excel, because that's what we usually use, we begin organizing it and we establish a series of schedules and tabs within Excel. What I try to get people to do is understand each one of those schedules, each one of those sheets in Excel is like a chapter of a book. And so you start to tell the story and you're writing chapters, and those chapters have to relate to each other, right? Because they all ultimately have to tie together. So first thing we do is we create a detailed set of assumptions, as detailed as we can possibly make them, right? So each assumption is like a separate character in the story, whether it's operating expenses, whether it's tenants, whether it's the size of the building, whether it is the efficiency of the space, doesn't matter what it is, okay? All of these things have a ramification, and they're like characters. So I'm trying to understand how this thing's actually gonna live and what this whole story is. So I think of them as characters. First question is, why am I analyzing this? Okay, because I want to, because I can. There's an objective. And we'll talk a little bit about this idea of making mutually exclusive decisions, because there's not an infinite amount of time and there's not an infinite amount of capital. And so our decision making is relative to every other opportunity that we have simultaneously. So we've got to be able to judge things not just based upon what we are intending to get out of it and what our requirements are, but relative to every other opportunity that exists at the same time. And those opportunities, okay, become trade-offs, opportunity costs to us. So the second question we ask is, what's my business? Why am I buying this? How do I expect to operate it? Right? So I push my students to tell me, give me your operating program. What's your business model? How do you intend to make money here? Right? Because sometimes it's not always clear how you intend to actually make money. And you've got to be able to clearly articulate that, because that affects your operating program. That operating a program affects your operating expense, and it affects how you intend to actually own this thing. And that changes the numbers. And the third question is, so I talked about the operating plan and those associated costs. So some things become really obvious. You know, you go through your due diligence, that kind of stuff. But we have different reasons for wanting to own something. We have different ways of owning things. We have different ways of operating. If it's a office building, it's a little simpler. If it's a development project that you're considering, especially if you're getting into mixed-use projects and things of that nature, that operating program becomes important, because it affects your marketing, it affects your operations, it affects the programming of the space, it affects the tenants that you try to attract to the project, and those kinds of things. So we do these usually in stages. But important part of this is this idea of GI-GO. So if you're young enough, you haven't heard this term very much. But for old guys, this was a term used at the beginning of the computer era. Does anybody know what it means? Garbage in, garbage out, right? So you make a set of assumptions, okay, and they're garbage assumptions, you're going to get garbage out. Now, your pro forma may look fabulous, and it may be incredibly detailed, and it's going to give you a result. The question is, how reliable is that result? So garbage in, garbage out becomes really important, all right? We try not to talk to ourselves in the mirror. There's this thing called decision-making bias, right? And decision-making bias has to do with what are the things that affect us as individuals when we make decisions. And there's a lot of different things that can affect us. So we've got to be careful about decision-making bias, because my baby's the most beautiful. My idea is the most ingenious. I know more than anybody. I've done this 1,000 times, okay? And we develop bias. And those biases are going to affect our decision-making. So it's important to get feedback. It's important to have other sources of feedback for you other than you and your own team, right? Because you want to make sure that you're really looking at this from a factual, clear-headed perspective, right? So we talk about matters of fact versus matters of opinion. And my saying to my students is, opinions are like asses, everybody has one, right? And there's a giant difference between a fact and an opinion. And people can they're entitled to their own opinions, as they say, but they're not entitled to their own facts. So the more facts we can get, we can validate, okay? And our ability to believe in those facts is going to help us make a less biased decision. but this is a process. So financial modeling, financial analysis is a process. It's designed to test your assumptions, right? So this is not a singular path that we're on. It's iterative. It's a decision-making tool, and it should be used to lead you to better management decisions. So let's talk about input assumptions for a minute, right? So we've got to start with a comprehensive set of assumptions before we can start the financial modeling process. Project characteristics, absorption rates, revenue, construction costs, pre-development expenses, operating expenses, timing, holding costs, blah, 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 blah. We know a lot of these, right? So making sure at the beginning of this, you understand this particular asset, you know why you want to buy it, right? You know how you're going to make money. You can create this very detailed set of assumptions. Then we need to begin thinking about our sources and use of funds. Right? So the pro forma gets set up around this basic format of source and use of funds. And what we're really after is trying to understand net cash flow for distributions. Right? That's the objective. It's not how much money you make, it's how much money you keep that matters. Gross revenue is important. Net revenue is way more important to me. Okay, and the most important thing to me is the amount that I get to keep of that net revenue. So we create this set of assumptions, this detailed list, right? And here's an example. I'm sure most of you are familiar with this stuff, but we end up picking certain elements in here that are variables. So certain things become fixed. I know the size of the building, right? We're designing a building and it's, I forget what this one is, but however big it is, 12,000 square feet, okay? That's a fixed amount of space, right? But within that 12,000 square feet of space, right, I have to also make decisions about how many suites am I going to have. This was a retail building, okay? Is it 1 story or 2 stories? Variables become things like rent, construction costs, things of that nature. So as I create my assumptions, right, I begin to identify those key variables. Because those key variables we're going to change, right? The size of the building is a matter of fact. That's not a matter of opinion. I can get a construction cost estimate from a general contractor. I can feel pretty good about that. I can call it a fact, right? I can estimate operating expenses pretty well, right? I need to get somebody to help me look at that. If I haven't done that, or I haven't gone to the general contractor, I'm going, well, I don't know, these are 180 bucks a square foot. That's a matter of opinion. I have no idea whether it's any good or not. Because I get people who come to me all the time and they go, here's this deal, what do you think? You think this is possible? And I'll go, yeah, it's possible. Everything's possible. It's all a matter of probability. Okay? So where'd you get these assumptions from? Where'd you get these estimates from? So I want to look at the key variables that will most affect the financial outcome. So I'm going to go back for a minute, and the question becomes, why am I analyzing this? Right? So am I solving for profit? Am I solving for land value? How much can I afford to pay for this piece of property? Am I solving for rent? Am I solving for some other thing? Because you have to be able to set this pro forma up for what you want to solve. So we typically move from a static to a dynamic financial analysis, right? So we'll go from back of napkin, simple, does this make any sense whatsoever, right? And then if it does, we can take it to the next level. And we begin adding this other element called time. So static models would be direct capitalization, which we'll talk about in a minute, right? Single period in time, direct capitalization to try and understand possible market value, to a full-blown cash flow analysis, which includes time in the equation, right? So you begin adding time. Start with a budget, those assumptions, right? Then you begin to develop a schedule of activities. What are all these things that have to happen, right? And I begin to then spread those assumptions out over time. And we begin to evaluate and adjust accordingly. So static models, direct capitalization, residual land value analysis, dynamic models, cash flow, yield capitalization, sensitivity analysis, and options analysis. And there's a whole bunch of derivations on all of these as well. So establishing financial metrics, right? Most analysis requires very simple measures, right? We call them figures of merit. Then we establish hurdles, and these are acceptance criteria. So you go into this and you say, listen, I need at least a 15% return, right? If I'm going to put my money in this, and I need that 15% return because I know I can earn 15% in these other deals. I've been earning them, right? And so I'm not going to do something unless I can earn at least that 15%. So that's an acceptance criteria. I won't accept this deal unless it at least meets that. That's the hurdle, right? The figures of merit are those metrics you're going to use to compare your acceptance criteria against. So people have different ways of looking at it. Some people are very simple cash on cash or cash multiple decision makers. Some of them are IRR driven decision makers, right? Some of them are NPV driven decision makers. You got to decide which are important to you and how you're going to make your decisions. But it's also a matter of perspective, right? So we look at projects from three basic perspectives. We look at the project, as I call it, pure. It's just the project. How is this going to perform? Then I look at it from the investor's standpoint. Then I look at it from the promote's standpoint or our standpoint, because all three of them are different perspectives. And this is where we start financially engineering these transactions. But the first thing I got to do is understand how this thing is going to function just pure without any financial structure associated with it. Just money in, money out, right? Before we look at distributions. So this is an iterative process, right? First we create initial simple analysis. We see what that tells us. We make adjustments. And the question is, what's the probability of achieving the results we need, right, in order to decide to go to the next level? So iterative, right? Assumptions, evaluation, adjustment. And the reason that in the assumptions page to begin with, we pick the most important variables, we want to be able to go back and change them. What if rent isn't at $1.50? What if it's at $1.80? What if it's $1.30? What if construction costs aren't 85, that they're 92? What if construction costs are 105? What we're trying to do with this thing is figure out where it breaks. That's what we want to know. I don't want to know how much money I can possibly make. I want to know where it doesn't work any longer. And I want to know what the probability of that situation actually is. So it's a predictive process. It's the best you can say for it, right? It's not absolute. This is not accounting. If this was accounting, right, it could be absolute. But it's not. You're using it to make a decision. And so it's a dynamic process. Everything's possible. It's a matter of probabilities. And we're not going to know the probability until we've been able to begin analyzing this and we consider all of our assumptions. So the other thing that becomes important with this, so as I said before, you make a bet. You've gone through this whole process. You feel good about your analysis. You go, let's do it, right? Plop the money down, buy the property, close on the loan, whatever you're doing, right? You just made a bet. Well, that analysis that you've done becomes the basis for project management, right? It doesn't end there, because now what we're going to do is figure out how good a bet you actually made. You're good better or crappy better, right? And so what we begin doing is looking at a project through the entire process right? And we are comparing it always back to that pro forma. So you create that pro forma and you go sell your investor, or you go to the bank and you close your loan. Where do you think that pro forma ends up? Any idea where that pro forma is located? It's located as an exhibit to your loan documents. It's included in your prospectus. It's a promise that you've made. That pro forma is a promise, okay, that you are going to go achieve these results. So if you've done a really bad job in creating the assumptions, even though the analysis looks pretty, and you sold it with a good story, the probability of really living up to that promise isn't very good. There's a lot of risk in that for you. And if you promise the bank you're going to do something, or you promise your investors you're going to do something, and you're wildly off, life is not good, okay? Life becomes uncomfortable. So it becomes really important to get this right, because it ends up becoming your budget. Your budget variance report is created from it. You have cost controls that relate to it. Your draw requests come from it, right? And your project accounting, your accounts payable, receivables, your financial accounting, all your tax prep relates back to that, right? So screw the modeling up at the beginning, okay? It makes your life really difficult. So cash flow analysis is really simple. We've gone from static to dynamic, so we're going to add time. So you've got sources of funds, use of funds, and you've got a time frame. Anybody ever use one of these? So very simple way of thinking about cash in, cash out. Okay? We're not talking about accrual accounting here. This is cash, right? And it's the timing of cash. So what we do is, once we've understood our sources and uses of funds, we've got those all down, and we start applying time. When's money coming out? When's money going in? Arrows that go up is money coming in. Arrows that go down are money coming out. And each arrow represents a time period. So it may be a month, it may be a week, just depends on what time period you pick, right? But we begin organizing the cash flow this way, so that we understand not just gross amounts, but we understand when we need it, when we're likely to get it. So you got to consider how you'll make money, how much money you're going to need, consider how you'll actually operate and develop the project, that's your strategy, and then convert that strategy to time. And the reason that understanding how you're going to operate it and your strategy is important is it affects the timing of the money. It may not affect the overall cash flow. We did this, the static model, back a napkin. This is a building of X number of square feet. We think the market is this. Let's assume a 92% occupancy rate at this rent. I think we can generate gross revenues of this amount, okay? Let's look at, we think our operating expenses are this, subtract them, pick a cap rate. I think we can pay this for it, right? That has nothing to do with timing. And I've seen lots of projects that make all the sense in the world on that static model, and people get killed because they didn't understand the timing of the cash flows. Okay? And if you get the timing of your cash flow wrong, even if it's a great project, you can be totally screwed. Okay? Because you need money today, but it's not actually coming for another 2 months. Right? And that doesn't work. So a couple of things, pragmatic things here. Forget sunk costs. People say to me all the time, but I paid this amount for it. I don't really care. Doesn't matter. Totally irrelevant to the analysis what you paid. Doesn't make any difference how much money you already have in the deal. Zero relevance. Forget it. This is about looking forward. Now, you can take that amount and for your own personal decision making, you can use it to analyze, but do not include it in your analysis, right? The other is, you should include opportunity costs, right? Because you have a finite amount of money, you can spend it only one place or two places or three places, but you can't spend it every place. So where do you think we account for opportunity cost? Wager a guess? What's that? Your returns, exactly, right? That's my opportunity cost is reflected in that hurdle rate. It's either in your IRR or some other measure, your discount rate, things of that nature. You include indirect effects from the project, right? Beware of allocated overhead costs, okay? If you've got an office and you've got people working for you, I don't really care. Don't include them in the analysis. Those are fixed, sunk overhead costs. They exist whether you're doing this or not doing it. What you're really trying to do is make a decision as to whether I should do this thing, right? Or should I buy this thing, develop this thing, etc. And that is irrelevant of all of these other things that you have at the moment. Separate investment and financing decisions, okay? So financing should be used as a mechanism for your strategy, right? Engineering, financial engineering. The thing's got to work first. If it works first and I can use financing to make it work better, all the better, right? So let's look at risk analysis and investment decisions. Anybody got any thoughts on any of that? So, two types of risk, systemic and unsystemic risk. We talked a tiny bit about that last time, right? What's systemic risk? Anybody know what systemic risk is? It's risk you have no control over, okay? Systemic risk is China. Systemic risk is the Treasury. Systemic risk is the Feds raising interest rates. Systemic risk is a plane flying into the World Trade Center. Got zero control over that, right? That's one of those things that we can't predict, those black swan events and other things out of our control. Unsystemic risks are things we have control over, right? So we have to account for both, but we want to avoid preventable risks. So preventable risks are things within that we have control over. We want to manage strategic risks. Strategic risks are risks that we knowingly take on purpose in order to achieve better outcomes. And I'm willing to take the risk that if I do this, there's more than enough additional outcome that I'm willing to do it. And then we have to understand the impact of those external risks, those uncontrolled systemic risks. Right? So part of what you're doing with your pro forma and the variables in your pro forma is trying to understand what happens when some of these things occur. Right? Because you have strategic decisions you can make, like what rent am I going to charge? Right? Or how big a building am I going to build? Or things of that nature. You can make strategic risk decisions, right, around all of those other factors as well. I want to build phase 2 simultaneously with phase 1 because I think the market is there and I can get out ahead of it, right? That's a strategic, controlled, unsystemic risk, but it affects the project. And you want to know what happens if you do that. So as I said before, everything's possible. It's all a matter of probabilities. People will ask me about a project and go, it's possible. There's about a 5% probability it'll actually happen, but who am I to tell you you shouldn't do it? Because it's possible. So you've got to understand probability. Greater the uncertainty, right, the lower the probability. Lower the probability, greater the risk. Uncertainty equals risk. That whole discussion at the beginning, we're talking about making decisions in an environment that we have no control over and that's always changing, right? That's not going to happen for years from now. The more of that you have, longer the horizon, right? The more variables, that creates more uncertainty. More uncertainty is more risk. How do we account for more risk? What's that? Higher returns, right? Probability of achieving investment objectives is why we're doing this analysis. We've set our hurdles, right? We've picked our criterion, so we can analyze. Lower the probability, higher the risk. Higher risk equals higher returns, bigger risk premiums. Key to setting financial hurdles, right, is understanding your measures of merit, understanding the risk, the uncertainty that's associated with a particular investment. So let's talk about figures of merit really quick, right? It's a number that summarizes an investment's economic worth. So an acceptance criteria is a standard of comparison. So we calculate the worth, we compare it to what our hurdles are, right? And that allows us to make a decision. So various figures of merit. Return on assets, return on investments, return on capital, cash on cash return, cash multiples, break even, present value, internal rates of return, modified internal rate of return, XIRR. There's a whole bunch of them, right? You got to understand what they actually mean, and you have to make a decision based upon your own particular situation. So what method should be used? It's really up to you. Let's talk about three of them really quick. Direct capitalization, right? Residual land value analysis, and cash flow analysis, which is yield capitalization. So direct capitalization, process of converting income into value. Basic formula, V equals I over R. Value equals income over return. That's a more detailed description of that formula, right? Gross potential income minus vacancy plus operating expenses equals net operating income divided by a cap rate. It's going to give you an estimate of value. Now, issues with direct capitalization, right? Really easy. People like to use it. It's super easy. Problem is, it reflects only a single point in time, right? Has nothing to do with the future. It doesn't account for inflation. It doesn't account for uncertainty. It doesn't account for any of those things, right? It's only a single number for a single year. So it's got limited use. What it's good for is comparing some alternative investments quickly and easily, right? But by itself, it's not the best figure of merit for decision making. So direct capitalization is convenient, but as I say, so is a microwave. But you don't want to cook everything in the microwave, right? And if you're interested in cooking a gourmet meal for somebody, the microwave may not be the best way to do it. So it's a way to measure how expensive a property is relative to others. So let's talk about yield capitalization. So what's the difference between direct capitalization and yield capitalization? Any ideas? Time. Okay, whereas direct capitalization is a single point in time, yield capitalization has to do with the time of the investment, your horizon, right? So it's to assess the ability of an investment to yield intended returns, right? It must be considered in performance over time. And so yield capitalization is otherwise known as what? You should know this. What's another word for yield capitalization? Internal rate of return. Okay, so we get yield capitalization and internal rate of return from this thing called capital asset pricing models, right? And I'm not going to spend a lot of time on this, but it describes the relationship between the risk and the expected return on investment used to determine an investment's appropriate price. And there's two factors that yield capitalization looks at, right? It looks at time value and it looks at risk value. Right? Those are the two big factors in yield capitalization. So that's the model, if you're really interested in it. It's a little more complex than direct capitalization, right? And this isn't the model for IRR yet either, but this is a little harder to calculate on the back of a napkin. Well, you've got an asset price, you've got a risk-free rate of return, you've got a risk premium, and you've got a market rate of return. So what that direct capitalization is useful for in this formula is figuring this component, right? That's the market rate of return. That's what are properties that are similar to this in the same marketplace earning at the moment. So, time value of money. We're going to talk about direct capitalization. We have to talk about time value of money. So we got things that affect the value of a dollar in the future or the value of a dollar today. Inflation, uncertainty, and opportunity costs. We have to include them. So how many of you know Popeye? Anybody ever watch Popeye cartoons? So he perfectly describes the time value of money, right? I'll gladly pay you Tuesday for a hamburger today, right? From his perspective, $1 tomorrow, okay, is less valuable than it is today. From your perspective, the opposite is true. I'd rather have the dollar today than tomorrow, right? So when you think about time value of money, think about Wimpy and Wimpy burgers, because that's effectively what he's saying. You can't simply add up all of the net cash flow from a project and say, that's what its performance is like. That is going to tell me what it's worth to me. So we've got to add time value of money. That's where we get to this idea of compounding. Compounding and interest, okay, are direct opposites of each other. So you've got compounding and you've got discounting. So compounding is very simple. I put $10 in an account today, right? And it's earning interest. And next year it's worth more, and the year after it's worth more, and the year after that it's worth more, right? But if I look at that amount 10 years from now, and I want to know how much I have to put in today to get there at that interest rate, I discount it. So all it does is the absolute opposite of compounding. Discounting is the opposite of compounding. So if I'm looking at $1 15 years from now or 5 years from now, whenever it is, and I want to know what it's worth to me today, I've got to discount it. So a very simple compounding example, right? Using 10% interest. It's worth $1.10 at the end of the year, simple interest, right? But if it's a compounding interest, the end of the second year, you're earning interest on your interest, right? So it's worth $1.21. And there's the basic formula, and it just keeps going and going and going and going and going. So if you expect $1,000 1 year from now, what is it worth to you today? And how much would you have to put in the bank today if you wanted to have $1,000, okay, a year from now at a 10% interest rate? So this is the absolute opposite of that. I don't have to put $1,000 in today because it's going to have compounding interest. So I'm going to put in $909 today at 10% interest. I'll have $1,000 in a year. Clear? So, discounting example. You put money in an investment earning 10% annually and promised $1 a year from now. What's the value of that promise today? So I'm going to go back to this discussion about making a promise to your investors, making a promise to the bankers, okay, for a project that's going to take several years to occur, right? And you're making a decision today. The reason that we go through this process is we have to figure out how good that promise is. So the interest rate in the present value calculation is called a discount rate. So you have dollars in the future, those are future value dollars. You have dollars today, those are present value dollars. If I want to find out how I get from future to present value, right, because those dollars in the future are worth less to me than they are today, I have to discount. Right? Discounting takes future dollars to the present. Question is, what rate do you use? But what you have to understand that there's an equivalency here, right? Those future dollars are equivalent to present dollars based upon the interest rate, the compounding and discounting you're going to go through to determine them. There's an absolute equivalency. That $909 we talked about before is the equivalent of $1,000 a year from now. So, net present value. So one of those figures of merit that a lot of people use is, what's the net present value of that investment? Because I want to know, what's it worth to me today? So NPV is simply a measure of how much better financially you'll be by undertaking the investment. Right, so that's what it's talking to us about when we get a net present value. So general rules of NPV. If an NPV is greater than 0, right, you should accept the investment. If the NPV equals 0, you're kind of benign, right? Take it or leave it. If it's less than 0, you should reject it. Very simple, right? So real estate is long lasting, and this is why yield capitalization is an important tool in analyzing suitability of an investment, right? It's the total return for the entire holding period expressed in a single annual rate. That single annual rate is your IRR, the internal rate of return. Internal rate of return is the rate at which money, when left in the investment, will continue to earn. Right? So if you have an internal rate of return of 15%, the money invested in that project is earning effectively a 15% compounding interest. That's what it means, as long as it's in the project itself. Is that clear? So, internal rate of return, just another merit, figure of merit. It's a close cousin to the NPV, and I'll talk about that in a second, right? It's the discount rate at which NPV equals 0. It's the rate at which money will continue to grow if left in the project, and it's also your opportunity cost of capital. So, you have a 15% IRR hurdle, right? I'm going to analyze a project, I get net cash flow, and what discount rate am I going to use to discount that net cash flow back to present value? It's a 5-year horizon. What discount rate do I use? 15%, right? Because that's what my hurdle is. And so the net present value at a 15% discount rate comes out to a positive $1 million. What does that mean?
Do it.
But what does it mean besides do it?
Your IRR is going to be higher than 15.
It means you made $1 million more, or you would make $1 million more, than if you had invested your money at 15% interest. That's what it's telling you. So the easy way to calculate the internal rate of return on something is simply to continue to change your discount rate for your net present value until you find 0. And the minute you find an NPV of 0, whatever that discount rate that got you there, that's the internal rate of return of that project. It's the rate at which money's earning into the future. And you're discounting it back at the same rate to get to 0 net present value, which means I put in this amount of money, I expected that return, that's how much I got out of it. A lot of people in this business totally misunderstand net present value. They'll look at NPV and go, that's what it's worth. No, that has nothing to do with that at all. So, character of NPV. If your hurdle rate is 15%, you use a discount rate of 15%, and you have a positive NPV, there you go. Your opportunity costs of not pursuing that are the $1 million. There's a $1 million opportunity cost by not doing it. So general rules of IRR, guess what? They're exactly like the general rules of NPV, right? If your IRR is greater than your acceptance rate, do it. If it's equal to your acceptance rate, you're ambivalent, right? If it's less than, that means it's a marginal investment. Don't do it. So what are the issues with NPV and IRR? Advantages of NPV and IRR, okay? NPV, the advantage is it's the only financial metric that tells you in real dollar terms how much better off you are, right? IRR is a percentage, right? It's the method, with IRR, the method advantage is that it shows you a return on your original money invested, but it's a return and it can fool you, right? I'm not a huge proponent of making decisions on IRRs. And here's why. It's time sensitive, right? And what happens is I can achieve a return that's infinite in an IRR calculation because I match my expense with my income exactly. And if that's the case, I have an infinite return. It may only be $2, but it's infinite, right? And it's very, very, very time sensitive. So it's not always the most reliable metric. I prefer NPV because it's telling me how much better off I am in real dollar terms today by doing something. So disadvantage of NPV. With IRR, the disadvantage is that at times it can give you conflicting results. So without going into a long discussion, the way that Excel calculates IRR, right, and the way that IRR formula works, you can get different outcomes all the time. And when you have significant unequal cash flows that are negative, you can get a wildly different kind of internal rate of return. So it's not as reliable. It's called the multiple IRR problem. And if you don't understand these things, you can end up with a result that you rely on that maybe wasn't very accurate. So the multiple IRR problem occurs when cash flows during the project lifetime are negative. So you put money in, you have nothing but negative cash flow, you sell something. Or you haven't sold it yet, but you're simply looking at an investment horizon and it's got lots of negatives in it. It's going to give you an outcome which is not necessarily very reliable. So let's talk really quickly about economics of buildings. Two kinds of analysis: front door analysis, back door analysis. Anybody heard of these? Okay, so two different ways of looking at an investment, solving for different outcomes using the same variables. So holds pro forma rent constant and solves for maximum land cost, right? It's a residual land value process. Necessary to achieve a target cash on cash return, right? So what we're doing is we're saying, listen, we know what rent's likely to be, right? Let's estimate expenses, and then we'll look at what the result is in terms of land value, right? But you can change those variables around. You can solve for total construction cost that you could incur for a particular project by holding rents at a fixed amount. So if you're super confident about what market rents are, and you're trying to figure out how much you can afford to spend to build something, you can use this analysis. If you feel confident about both of these, you can then use it to determine how much you can afford to pay for the land, right? So that's backdoor analysis. Front door analysis, right, holds development costs constant and solves for minimum rent. So what you're doing is you're saying, okay, I know how much I'm paying for the land. I know what my construction costs are going to be. How much rent do I have to achieve in order to achieve a particular profit margin, right? So you're solving for the amount of revenue that you have to take in. Basic formula that we use in all of this is gross income less vacancy factor, adjusted gross income less expenses equals your net operating income less your debt service, gives you your free cash flow. This is what we're all after. It's free cash flow, right? So, simple example. Gross income, 460,000, 5% vacancy factor, adjusted gross income, operating expenses, net income, cap rate gives us an estimated value. So this is direct capitalization, right? Estimate of value for a project. Really simple. You vary this, that goes up, what happens to this? Goes down, right? Higher the cap rate is, the lower the value, because you have to achieve more return. You have a higher return requirement, which means you can afford to pay less for that amount of income. Does that make sense? So, same thing, we drop the cap rate to 8%, see what happens to the value. You increase it to 11, you see what happens to the value. Because the thing that's constant is the income. The income, the expenses are the same. You hold them constant, right? You change the return requirements on that net income. That means you can afford to pay less to own that cash flow. So residual value is a way of estimating the value of a piece of land. So as we talked about last time, land is said to be worth its productive capability. As we change its productive capability, its value changes. So when you're trying to figure out how much you can afford to pay for something, you can do a residual land value analysis. If it's vacant land, right, that's one thing, but you can also do it on existing buildings by looking at the depreciated value of the existing building itself. Same analysis. So we're looking at productive capability. Residual land value is calculated by looking at the capitalized value of a projected project or a real project, less the cost to create it, plus a profit. So in residual land value analysis, profit is considered a cost. When we're talking about front door, back door, keeping things constant, I'm not solving for profit here. I'm solving for the value of the building or the value of the land. And so I have to include my profit as a cost in the equation. So here's an example. 65,000 square foot building, maximum building or site, 130,000 square foot building, rent at $28 a square foot, vacancy assumed to be 5%, operating expenses, estimated construction costs, direct and indirect, and a cap rate of 7%, right? These basic assumptions. So what that means is I can afford to pay $139.70 a square foot for that piece of land. Assuming all of those assumptions are good, right? That's a static analysis. I change any of those. I change the rent, right? I go back here and I change the $28 to $25. What happens to my value? I can afford to pay less for that land. So residual land value is the way of looking at the value of land both in real dollars and in relative dollars. Okay? This is why a piece of property just off the corner is worth less. It's worth less because you probably can't generate as much revenue from it. Building costs exactly the same to build. It's just that you're generating less revenue out of it. If you're generating less revenue for the same cost, you can afford to pay less. So, conclusion here, because I know we only have a finite amount of time. Understand your project. Due diligence is critical, right? Because that's where you get your facts from. Matters of fact, matters of opinion. Due diligence is critical. You don't do a good job of that at the beginning. You don't have good input assumptions. You don't have good input assumptions. Garbage in, garbage out, not reliable. Make reasonable assumptions, right? Make estimates of probability, all right? Make assumptions about what's likely to happen. Determine relevant cash flows, right? Don't include things that aren't relevant. Sunk costs are not relevant. Fixed operating expenses, overhead expenses, not relevant, right? You got to make sure you include relevant expenses. Establish appropriate criterion and hurdles, right? Those are your decision-making tools. Analyze the cash flows with figures of merit, compare it to your hurdle, and assess the quality of the investment opportunity. So, words of wisdom. Cash flow analysis is a method of worrying before you spend your money instead of afterwards, right? So it's cheaper to lose money on paper than it is in reality. The reason we go through this modeling process, right, is to make sure that we don't lose money in reality. Or what we're really trying to do is that there's nothing that's certain, is we're trying to increase the probability of making a good decision. Questions? Okay.